Well, hello there, everyone, and welcome into today's video where we're getting all into funding our real estate investment deals. And we're going to be talking about everything from funding the acquisition of a property, the rehab of a property, and then even funding our buy and hold properties. That's really real estate investing in a nutshell, everybody. We're either flipping or we're renting for cash flow. That's how to make money in this business. And I really have never met anyone who didn't use financing, who didn't use leverage, who didn't use lenders to fuel their real estate investing operations. I guess maybe there's a a trust fund maybe out there somewhere running around with a blank checkbook and doing it, but for the most of us, for the rest of us, we need to rely on lenders to fuel our real estate investing business, to give us the momentum to get out there and do transactions. So since we're relying on lenders, it's going to be good to understand the different types of lenders and the different types of loan programs out there. And that's exactly what we're getting into in today's video. So different types of loans. We're going to be talking about the loans that retail buyers use. This is important to understand because when you're buying a property, fixing it up, and selling it to a retail buyer, somebody who's going to buying the property to live in, these are the types of loans that they're going to be using. We're going to put a big emphasis on bridge financing, and bridge is just a fancy term, lending term for the money you're using to buy and rehab an as-is property. Remember, you're out there buying properties as is, and you're going to rehab it to either resell for a profit or refinance the property to make it a cash flow investment rental portfolio property for you. So the bridge financing is temporary financing that is used from the bridge to taking the property in its acquisition as is state to your exit strategy. It is temporary. It is just a bridge to take you to your exit strategy, whether it be flipping or a buy and hold. And we're going to be talking about investor financing for flipping and for buy and holds. You're going to be really dialed in on this stuff here. So we are going to be talking about the difference between private money and institutional money, the benefits of 100% financing when you're out there wheeling and dealing, LTV versus LTC. This is loan to value versus loan to cost. I'm going to explain what this stuff is. We're going to be talking about draw schedules because sometimes lenders will give you your rehab money in draws, not all in one fell swoop. And we are going to be talking about really our favorite way to fund our buy and hold properties, and this is DSCR loans. You're going to know what this is. First off, retail loans. Remember, this is what our retail buyers, people who are buying the property to live in, that's considered a retail buyer. These are the types of loans that they're going to use. A conventional loan, this is just a good old-fashioned homeowner loan where the buyer is putting down 20% down payment for these loans. So it could be considered that that's somewhat of a stronger buyer. An FHA loan is where the buyer is only putting 3 to 5% down. Typically, the credit requirement is a bit less than a conventional buyer, so maybe their credit score is a little bit lower, less of a down payment. Still really great buyers. We sell a lot of properties to FHA buyers. But a conventional buyer or a buyer using a conventional loan could be considered a bit more strong or a stronger buyer when you're out there selling your properties. And then a VA loan, these are for our great veterans who have served our great country, and they get a better interest rate. They earned that, right? Because they served our country, and I wish they got even a lower interest rate, right? They deserve it. I think we need to be taking care of our veterans out there. Now, I did want to make the point. The conventional loans, we're talking about selling properties to retail buyers. You, as an investor, you can use conventional loans to fund your buy and hold properties. The alternative is a DSCR loan. We're going to put a big emphasis on DSCR in this training, which you're going to learn about here in a few minutes. But the alternative is you could use conventional loans to fund your buy and hold. And these are actually a little bit better than a DSCR loan simply because they're cheaper. There's less fees, less costs, and you still got to do that down payment though. So there's pros and cons. I just wanted to make the point. Everybody is allowed to get, you as a real estate investor, you're allowed to get 10 conventional loans in your name. And that's it. That's the max. That's the cap. And this is going to provide you typically less fees and a lower interest rate than a DSCR type of loan for your buy and hold. You're either using a conventional loan or a DSCR loan. It's one of the two, right? For these refinances for your buy and hold portfolio, conventional loan is going to be cheaper, but you're limited to only 10. You're going to see the most conventional loans when you're selling properties. And again, typically those are considered the strongest type of buyer. So, types of loans, bridge financing. Remember, this is the temporary financing you're using for acquisitions and rehab. You're using these temporary loans that's coming from a private lender or an institutional lender. We're going to discuss the differences of these two. And you're using this money to buy the property in its as-is condition and fix the property up to take this property to your exit strategy. This is the bridge used to either flip the property for a profit or refinance the property to make it a rental. A bridge financing or a bridge loan could be considered a hard money loan. It could be considered just temporary financing you're using to make as is offers to sellers, and the money that you're using to fix it up, it is temporary. You're not leaving this in place because typically it's going to be expensive. You're going to pay a double-digit interest rate. You got to expect to pay to play here. This is considered risky loans for the lender simply because you're buying a property to fix up. So these lenders, are willing to give you the money, and you're buying a junker property. It kind of needs work and whatnot. That could be considered a high-risk loan for the lender. So they're going to charge you kind of an arm and a leg, but hey, we rely on this stuff. It's better to pay a higher interest rate and pay some fees and whatnot to get these loans and to get in the game and do deals and do profit. I've met investors in the past who said, I'm not paying 12%, I'm not paying 13% for this acquisition and rehab money, and they never end up getting out there and doing deals. Right? The interest rate and the points that you pay for these loans is minuscule compared to the profits that you can generate. So just keep that in mind. This is a necessary evil, I guess you can be considered. And the interest and the points and the fees that you pay for this financing, it's just a business expense at the end of the day, because when you sell these properties or refinance these properties to pay them off, now you have an asset or you're making profits, okay? So, BRRRR or fix and flip money, when you're out there making offers to motivated sellers, you're using bridge financing. You're using this acquisitions and rehab money when you're buying something that you're going to fix up to rent out or sell for a profit. And then I just wanted to make a note, transactional funding. If you remember back in the wholesaling video course, portion of this course, we talked about double closings. And sometimes when you have a really big spread on a deal, you're not going to want to just do a straight up assignment. You're actually going to want to buy the property and then resell it immediately and do that double closing. That's transactional funding, right? We talked about the pros and cons of doing those types of double closings, but that could be considered bridge financing as well because it is temporary financing. Bridge financing is considered anything temporary. So that transactional funding for those double closings, I guess that would be actually considered bridge financing as well. Just wanted to remind you of that portion of the training. So private money versus institutional money. Institutional money is just a lending company. Private money is a private individual, a doctor, a dentist, or the lady that you used to help out. Maybe she's got money sitting in the bank, right? She's just a private individual who's lending you the money. An institution is a lending company. There's tons of them out there. In our private coaching community, we get heavy into how to raise private money. RJ and I have built our entire business raising private money. We've raised tens of millions of dollars from private individuals, and you're going to see kind of the pros of working with private individuals. But we also, within our private community, have these companies that will provide the bridge financing for you guys so you can get in the game and get deals quickly, right? Now, 100% financing is key. Remember how we talked about we need to borrow money for purchase and for rehab, acquisition and construction. So if you could get all the money that you need and not have to bring any skin in the game, that's always ideal from a business standpoint. And private lenders are going to be easier to work with. There's going to be less kind of paperwork involved. It is always an easier way to do this. So I just want to make these points. We're going to look at institutional lenders because A lot of you guys, we use both, everybody. I mean, we use private lenders. At this point in our career, we're only really using private lenders because we have so many relationships. But when you're getting this thing going, if you don't have a Rolodex of private lenders, you're going to be relying on these companies. And they don't like 100% financing. They're not really interested in giving you all the money that you need for the purchase and the rehab. They're going to want to see some skin in the game. And they're looking at these deals from a standpoint of LTV and LTC. Let me explain the difference here. LTV is loan to value, i.e., you can find a lender out there who's willing to give you 70% loan to value. So let's say you're looking at a property, the ARV is 150, right? Well, it says 75%. So forgive me, I put 70% in loan to value, 75% is 112.50. So let's pretend you got a lender who's willing to give you 75% loan to value and the ARV is 150. That means the lender's willing to give you 112,500 straight up. All they're looking at is the end value of the property. What is 75% of that? And they're going to give you 112,500. So if you're buying the property for 100 and you're putting 10K into it, well, that would give you all the money that you need to buy it and fix it up. If they're giving you 75% of the value, regardless of what you're paying for the property, the remainder goes towards the construction. That's great, right? This is a good little deal where you could get all the money that you need. Now, in institutional money, they don't like giving you 100% financing, so they loan based off something called LTC, which is loan to cost. And a good example of that is they'll give you 90% of the money that you need. So let's pretend that you're buying this property for 112,500. Just as an example, well, they're only willing to give you 90% of the money that you need. They're only willing to give you 101,250, and they're going to want to see you to put a down payment to fill that gap. Sometimes you might hear in this business like, "Oh, I need gap funding." What that is somebody who needs money for the down payment to do this deal. That's a real risky loan, by the way. And that's how these institutions work. They don't want to give you 100% financing. They want to give you 90% typically of the money that you need. And they're going to want you to give that down payment and put some skin in the game. And that, my friends, is why typically private lenders are going to be better, because it's way easier to get a private lender to just give you 100% financing than working with these institutions. But necessary evil. If you don't have private lenders lined up, you got to work with the companies. So the institutions or these companies also want to give you your rehab money in draws. They don't typically want to give you all your money up front. A private lender will give you all your money up front, and that makes it so much easier to transact, so much easier to do business. You can get your crews working. You got all your rehab money up front. You don't need to go to the lender and say, "Okay, I'm done with phase one. I'm done with phase two." So the way these institutions give draws is typically you use their money to acquire the property. They got your rehab money in an escrow account, and then you're actually got to fund the rehab out of your pocket and then bring the lender these receipts and whatnot, and then they will reimburse you. So that's more money out of your pocket. It's tougher to scale if you are simply relying on institutional lenders. It's way easier to scale when you're working with straight private lenders because they're going to give you 100% financing and give you all that rehab money up front. You don't need to mess with draws. Do you guys see that? So it's a bit more cumbersome when you're working with an institutional lender, but some people, that's all they have access to, and that's perfectly fine. But a lot of times to release these draws, they want you to front all the money for the phases of construction, and then they will refund you or reimburse you that money. And that is just another example on why private lenders are better. I'm putting a big emphasis on that because we have built our careers off working with private lenders. We're experts at raising private money, structuring private lending deals, and we talk about it constantly ad nauseum in our private coaching community. It's something, if you want to take this thing to the next level, you've got to be out there raising private money. Now, a big way that ourselves and many people in our community are funding your buy and hold is with DSCR loans, and that stands for debt service coverage ratio. and is essentially a buy and hold loan for you as an investor, a buy and hold 30-year fixed rate loan kind of deal. And the loan is based off of how much rent this property is producing. Now, remember when I told you when you're funding your buy and holds, it's typically only going to be a conventional loan or a DSCR loan. That's kind of the two products out there. Well, remember how I told you conventional loans, you're only allowed 10 of them in your name? Well, with DSCR loans, there's unlimited number of loans that you can get. Now, it is going to be a bit more expensive. You're going to pay some points and fees, and the rate might be a little bit more, but a lot of times it's still worth it. We use DSCR loans all the time. They're great buy and hold loans for investors. So let's walk through just mentally. I want you to visualize you find a property in its as is condition, you buy the property, you fix it up with a bridge loan, then you take it to a DSCR lender and they're going to refinance this, give you 30-year fixed rate money based off the rent that this thing is producing that pays off your bridge loan, and now you just have a 30-year fixed rate loan in place. So it is a good way to build your portfolio, and the loan is based off the rent. Typically, these DSCR lenders want to see the rent needs to be 1.25% of the PITI. Maybe you got to watch this video a couple times. I'm kind of throwing a lot at you here, but let me know what questions you have, and you're going to be masters of this thing by the time we get done with you and coach you up here. So typically, the lender wants to see the rent 1.25% X the PITI payment. So let's pretend your PITI payment on this rental property, that's principal, interest, taxes, and insurance, is going to be $1,100 a month. Well, take $1,100, plug it in your calculator, times it by 1.25, and they want to see that the rent is minimum $1,375 if your PITI payment is $1,100. You can do this. Just plug in your PITI payment into a simple calculator and then times that number by 1.25, and that's where the minimum rent needs to be. And this is another reason, everybody, why we love that affordable housing sector. We love those homes between 100 and really 250 is the max, because that's where you can more easily hit these rent to value ratios. Remember, we talked about that in previous videos. You know, we want to be in that affordable housing sector because it's way more likely you're going to hit 1.25 of the rent or of the payment with an affordable housing type of project or a property. If you're buying a property that's 300, 400, 500,000, well, your payment on that loan would be so high, it's almost impossible to get 1.25x of the payment. Does that make sense? So if you're buying a $400,000 property, your payment on that thing might be $3,000 a month. If you times that by 1.25, well, I mean, are you really able to rent this thing for $4,500 a month or whatever that number is? Probably not. So the affordable housing sector is ideal for this because you have unlimited loans and you have access to these DSCR loans. But again, the rent needs to be 1.25x minimum of that PITI payment. That's why we love those price points between 100 and 250, because that keeps that PITI payment reasonable, right? The loan balance is going to be smaller on those. Therefore, you can still hit that requirement of 1.25x of the payment. I know I'm throwing a lot at you. Hang in there. You guys are going to be masters of this thing. Come hang out with us in our private community. I'm plugging it, but it is what it is. If you want to really sink your teeth in and have full access to all of our lenders, learn how to structure your private lender deals, have full access to our DSCR lenders, the whole deal, that's what's going on in our private community. So in summary, everybody, private lenders are always the best simply because they're the easiest to work with. It's the lowest amount of paperwork for you. You know, they're not really requiring inspections. They can give you 100% financing, which is key. No skin in the game. And the big added bonus is they'll give you all of your money that you need up front. So you can get started on your project right away. You don't need to mess with draws or anything like that. If you are reliant on institutional lenders, that's perfectly fine too. There's still plenty of money to be made. Make sure you're just kind of looking at your interest and points and costs. That's all just a cost of doing business. You're here to make profits. You're here to acquire assets. You got to pay to play. It is what it is. When we're setting up, I just wanted to give you a nugget here. When we set up our private loans, our private lender loans for our flips and even our burrs, where we're buying something to fix it up and then refi, we set it up as accrued interest. So there's no monthly payments. You want to talk about maximum scalability? Well, check this out. What if you get all the money that you need for the purchase rehab? You get all of your rehab money up front, so there's no draws and there's no payments on this thing. You pay all the interest when you pay the lender back. So that is the way to do this thing, and this is how we do it, and this is how we teach people how to do it. I'm here to let you know, if you're working with private lenders, you're going to want to set up 100% financing, all of your rehab money up front, and set it up so the interest is accrued. There's no monthly payments. All the interest is paid at the end when you refinance or sell the property to pay the lender off. Institutional lenders are still great, but expect you got to have some skin in the game. And DSCR is great, especially if you're all in. All in is all your purchase price and purchase costs and rehab for 75% or less of the ARV, right? And again, one caveat there is the rent needs to be 1.25x of the PITI payment. Watch this video again. I want you guys to master this stuff. Hit me up with any questions that you got. But financing is extremely important. The only way you're going to do this thing and acquire assets, you got to rely on lenders. So you got to know what you're getting involved with. And we're here for you every step of the way. All right, moving on. We still got to get into finding these motivated sellers, negotiating with these motivated sellers. We got a lot more here for you. So everybody, I will see you all on the next video.